Good morning, everyone. I am C. Amit Bhatia, and we are here to discuss the module of foreign exposure and risk management. In the previous session, which was taken on 29th November, we had basically started with the concept of swap points or forward points. Swap points are generally mentioned just like your bid or ask rates. You are given with hyphen. However, sometimes they are given as numerator upon denominator. So in that case, remember, we had discussed that when the swap points are in an ascending format, that is numerator is lesser than denominator, then in that case that is premium. And if it is the other way around, that is, say for example, if you have the numerator which is less than the denominator, then that is discount, meaning that the currency is trading at discount on the forward rate, that is 3 months, 4 months forward, as the case may be. Thereafter, we had solved some questions wherein we essentially looked at the possibilities or the alternatives available in hedging, right? So what had we covered? We had essentially covered under in the hedging, we have essentially covered so far how forwards work, right? Then we had looked at how money market hedge essentially works. We also looked at options, how options work, right? Now, today, our objective is we are going to look at a question on which we are essentially comparing all three of them, right? And then we add the fourth option also, which is the fourth option is where you are doing no hedging. Now remember, we need to essentially, if you are the finance manager, then you will have to make this decision and report it to your management, or if you are the decision maker, you will need to make this decision based on the option which is most economic for your organization, right? Which means where you will have least amount of outflow. Say, for example, if you are an exporter, then in that case, our objective is to maximize the inflows, right? So we opt for that option, which is going to maximize inflows for our customer, client, or the company, as the case may be, right? So we had already looked at these individually. Now we are going to start today with all the four options in a single question to essentially determine which option is better given the facts. So let us start with question number 5. Question number 5 in assignment sheet number 2. Question number 5 in assignment sheet number 2. Assignment sheet number 2. Let me take it over here. All right. So what does my question have? Question number 5. XYZ Limited, a US firm, will need pound 300,000 in 180 days. In this connection, the following information is available. Spot rate, 1 pound is equal to $2. £1 is equal to $2. 180 days forward rate of pound as of today is equal to $1.96. Interest rates are as follows. So we are given the interest rates of UK and US respectively, right? So,
Amit sir,
yes, sir.
I think you just better to disclose. Okay, you just make the adjustment because there is some adjustment issue.
I'm sorry, sir.
There is, see, when you I think you have cut paste this question, na?
Yes, sir. Yes, sir.
I think there is some alignment issue is there.
Yes, sir. there was only for UK and US over here. So I believe everybody already has the assignment sheet as such, right? Hello? Is this better or do you want me to share the Word file?
Is the Word file is available on the? I have also shared the PDF as well, no, sir, with you.
Yes, yes, sir. Just, okay, I'll do that right away then.
Okay, now you can do the adjustment here, alignment here. From the next onward question, you use the PDF, sir.
Sure, sir. Works.
Okay. Okay.
Yes,
Just
yes.
make the adjustment of alignment in this question quickly, so that the student time.
Yes. All right. So interest rates are as follows. 180 days deposit rate in UK is 4.5% and borrowing rate in UK is 5%. In US, deposit rate is 5% and borrowing rate is 5.5%. A call option on pound that expires in 180 days has an exercise price of $1.97 and a premium of $0.04. XYZ Limited have forecasted the spot rates 180 days hence as follows. So what is the future rate probability? $1.91, there is a probability 25%. $1.95, probability is 60%. Right? And $2.05, probability is 15%. Right? Which of the following strategies would be most preferable to XYZ Limited? A forward contract, a money market hedge, an option contract, or the fourth one, which is no hedging. Show calculations in each case. All right. So first and foremost, we have the first and the fourth part, which is comparatively very, very straightforward and easy, right? A forward contract essentially is going to be on which rate? On $1.96, right? So I can directly take into account, as far as forward cover is concerned, what will be my outflow. So what is going to be my outflow if I book a forward cover today? It will be 300,000 pounds into $1.96. So that will give me the forward amount. Similarly, no hedging, wherein essentially you are depending on the spot rates, right? Because there is no hedging. So whatever is my expected outflow, that is 300,000, I'm going to wait over here without any hedging tools. And in future, whatever is the rate, what will be the rate in future? You are already given what is the future rate and the probability. So you multiply this with the probabilities, the amount that you get, right? It's basically simple probability into xi. So say for example, here it will be basically nothing but you will have to do pixi and I will get the forward future rate, right? Future spot rate, because at that I will close my position. These are two, you can say, very, very low lying fruits for you. We can easily do them and essentially get our marks for that. Now, in the further part, a money market hedge and then option contract that we will essentially work on, right? Let's start the solution now. Let's start the solution. Okay. All right. First and foremost, forward contract cover, right? So, A, I have forward contract. So what will be my outflow in this option? Outflow of USD. How much will be the outflow? I need essentially 300,000 GBP, which I am going to book at 1.96 forward rate, right? So that will mean my outflow is going to be, this is going to be USD 588,000, right? So this is my first option. In the examination, we try to always ensure that whatever is my low lying fruit for me, right? I essentially book that very fast. and then we go on to something which is going to test or going to take more time, right? All right. So now this is my first part. What is my D option over here? No hedging. No hedging. No hedging. All right. So in no hedging, I need to essentially find what will be the future spot rate, right? Do I know the future rate? I don't know future rate directly, but I know what is the future rate probability is given to me, right? So I can identify 1.91, 1.95, and 2.05. Probabilities are 25%, 60%, and 15%. Whenever probabilities are also always given, please check it is 100% information is available to you. Yes. Now all I need to do is multiply future rate into the respective probabilities, right? And I get the answer.
1.955.
1.955. So now in this case, how much will be my outflow? How much will be
586.
my outflow over here now? Here it will be 1.955, right? 955. So I will have an outflow of 586, 500 USD. Are you all with me? So far, so good?
Yes, sir.
Yes, the two easier options have been already been completed by us. Now we focus on the second option, which is money market hedge. All right. Money market hedge. Now, before I start, do I have a obligation over here or do I have a asset which I'm going to get? 6 months.
Obligation.
Obligation, sir.
XYZ, a US firm will need pound 300,000 in 180 days. In 180 days, I will need pound. So I have a liability over here, right? I have a liability over here. Yes. So I have a liability. How much is my liability? Pound 300,000. In order to meet this liability, I need to create an asset, right? This asset should have how much maturity value? Pound 300,000, so that it will be able to take care of the liability. Am I right?
Yes,
If I
sir.
want this asset, I need to invest some money, right? So I'm going to invest something over here in pounds. How much will be the present value over here? This will be 300,000 divided by 1 plus whatever is the rate of interest that you are going to earn on your investment, right? So what is the investment rate over here? Are we given that in the question? When you invest in pound, that is in UK, how much is the rate of interest? You are going to earn in UK 4.5%. It is given to you over here, right? You are given over here, you are going to earn 4.5% in UK. This is a 180 days deposit rate. Now, normally, interest rates are always mentioned as per annum. Okay. So here I am assuming this is, since it is given to me as 180 days rate and it is not given to me, it is per annum. So I am taking this to be 4.5%. But practically speaking, generally you will always find the rates are mentioned in per annum basis, right? However, here nothing is mentioned. So I am going to take it as 1 plus 4.5% because it is a 180-day rate, right? All right. Now, based on this, I will get a certain amount. How much amount will I have over here now?
287,081.
287, 080, 281 pounds. Am I right?
Yes, sir.
0.34
Point
sir.
3.4, right? Okay.
Yes.
Now, if I want to invest over here, that means I will need to borrow, right? So I'm going to borrow from where? In which currency?
Borrow US.
Yes, I will borrow in
Dollars.
USD. How much
Dollar.
am I going to borrow in USD? What is the spot rate today? Because I have to do this today, right? So what is the spot rate today? I took a loan and I need to buy pound today. So what will be my rate today? Do I know the spot rate?
Yes. 1 GBP dollar equals to $2.
It is, yes. Today's spot rate is 1 pound is $2, right? So I have to take today's rate, which is here. So it's going to be 287,081 into 2. So what will that amount be?
74,162.
574. Please don't forget the 34 cents which were there, or rather shillings, right? 574,
162.68.
162.68. This is the USD which I will borrow, right? Now, when I'm borrowing this, do I need to pay some interest on this? Would I have to pay some interest on it?
Yes.
Yes. At what rate? Borrowing in USD happens at what rate?
5.5%.
I have 5 point, yes, US borrowing is happening at 5.5%. So I'll have to pay over here interest at the rate of 5.5%, right? So now I am going to have the outflow of 574,162.68 plus 5.5% interest. That will be my outflow on the money market hedge. So now let me put this over here in the working. All right. So first and foremost, what am I going to do? I need a asset, right? So 180 days later, liability is there. Liability is how much? GBP 300,000, right? So I'm going to create an asset. So for that, do I need to now go in the reverse way right now? I've already done that over here. So I can directly start with, I'm going to borrow in USD. How much do I need to borrow in USD? Yes. How much do I need to borrow in USD?
At 2 rupees spot rate.
2 rupees spot rate?
2 rupees, $2, sir.
Yes. So how did I go about getting that? So first of all, I need to invest,
Present value.
right? Today. How much? I need to invest in GBP today. How much? How much? So I can say it's going to be 300,000
Divided by 1.
divided by
1.045.
1 plus 4.5%, right? So I'm going to, this is here, right? And here I will essentially put this as a working available to you, which is easily visible to you, right? All right. Now I need to invest in GBP today. So I need 287,081. So borrow in USD, how much? So borrow in USD because the prevailing spot rate is what? Spot rate is 1 GBP is equal to USD 2. Am I right? Already given in the question. So I'm going to say 287,081 into 2. So I need 574,162.68 USD. This is my borrowing today. Add interest at the rate of 5.5%. Now remember again, we are told it is 180 days interest. Normally, had it been mentioned as per annum, then in that case, we would have taken into 6 upon 12, right? Here, we always assume the year is of 360 days. And the reason for that is this is money market hedge, right? So in money market, year is always considered for the purpose of calculation of interest of 360 days. But here nothing is mentioned. So I have to take entire 5.5%. So I get 31,578.9474. Is everyone clear with this? Right? I can put the numbers over
Yes,
here.
sir.
574, 162.679. Right? So this is the working. Okay. All right. So what is my total outflow of USD now? What is the total outflow of USD for me now? 574 plus interest. So my total outflow is going to be 605,741.627. Are you all with me?
Yes,
Yes.
sir.
Okay. Now we go to the third option. What was my third option? First option was forward contract. Second option was money market hedge. Our fourth option given to us was no hedging. And the third option is an option contract.
Option H.
Okay. So let's take that. See. Option contract. All right. Now, in option contract, what is being mentioned to us? A call option. Let me take you to the question again. Is over here. You can see over here. A call option on pound that expires in 180 days has an exercise price of $1.97 and a premium of $0.04. XYZ Limited has forecasted the spot rates 180 days hence as follows. So we are given that future rates, which is 1.91 into 25%, 60%, 15% respectively, right? All right. So now we are going to identify, because what is going to be my outflow? My outflow is going to be outflow for us is going to be essentially in terms of this future rate into probabilities, right? So at that rate, I will have outflows, but I will also need to determine, remember this is an option contract. So if the rate which is prevailing in the spot market, since this is a cost for me, right? So if the rate available in the market is, let's say for example, 1.90. So if the rate available in the market, the spot rate, I'm just giving this hypothetical example right now, right? So if the rate available in the market, say for example, is 1.90, right? And I have over here exercise price in the option, I have exercise price of 1.97, right? Plus I'm going to have a cost of 4 paisa as premium or 4 cents as premium, right? So my overall cost over here becomes 2.01. This is a cost which I have already paid. So that is a sunk cost for me. But my comparison over here is going to be essentially between 1.90 and 1.97. So when I'm getting in the spot rate or in the spot market at 1.90, will I exercise the option of buying this?
No, sir.
Obviously no. Then in that case, I'm not going to exercise it because I will buy it in the spot market, right? Say for example, if the spot market is trading at 2.05, that is also one of the options which is given to us, 2.05. So if 2.05 is the prevailing price in the spot market, will you exercise the option?
Yes.
Yes, definitely. Because in that case, I'm going to save how much? I'm going to save 8 cents, right? So then in that case, definitely it will be a in the money option and you will exercise this option, right? So I'll need to essentially prepare the working over here. Let's do that, right? Let's do that. First of all, I write expected future rate. expected future rate. What are the options I have? 1.91, 1.95 and 2.05. 2.05. Right? These are the three options I have. What is the premium I have to pay? Premium per unit. If you want to buy a call option, you need to obviously pay the premium. Am I right?
Yes, sir.
So premium per unit is going to be 0.04. Irrespective of whatever is the future rate, you will have to pay that. What is going to be my exercise option? Okay. That I am going to determine based on total price per unit for me. So here, what will be the total price for me in case of first option? It will be 1.91 plus 0.04. Am I right?
Yes, sir.
Yes. In the second case, what will be the total price for me? 1.95 plus 0.04. So it will be 1.99, the total cost for me. Are you with me?
Yes, sir.
Very good. Now, third most important part. Tell me what will be my total price when the expected future rate is, say, for example, 2.05.
The 2.05 minus exercise price plus premium.
2.05 minus?
Exercise price वो gain देगा and the outflow is minus 0.04. Net flow will take.
Okay. Let me come back over here. If the price in the future rate, that is spot rate, this is the expected future rate, which will be the spot rate at that time, 180 days later, will you exercise this option?
So no.
Will you buy at 1.97 under the option contract, or will you buy it in the spot market at 1.91?
In the spot.
In the spot market. So exercising option is going to be no. Are you with me?
Yes, sir.
If the future rate is, say, for example, 1.95, right, in the spot market, will you exercise this option?
No.
No. Why not? Now you might say, sir, total cost of 1.99 hai, right? But remember, this 4 paise or the 4 cents which you have spent, that is already a sunk cost for you. So I am going to essentially compare between 1.95 and my exercise price. What is the exercise price?
1.97.
Exercise price is 1.97, right? Okay. Now, if the expected future rate is 2.05, will you exercise the option? Again,
Yes.
the comparison is between 1.97 and 2.05. Will you exercise the option? Yes,
Yes.
because it saves me 8 cents, right? But overall, what will be my total cost in that case? My total cost is going to be 1.97 plus
Plus
0.04.
0.4.
Am I right?
Yes, sir.
Right? This is important, okay? Why did this happen over here? We were so far adding these two. So why did we essentially subtract? It is not 2.05 minus 0.04. Please note that. This is basically the cost, which is 1.97, which is my exercise price, plus I am adding 4 paisa or the 4 cents, which I have paid as premium. So that gives me my total cost, right? Okay. All right. Now that I have found out what is going to be my total price and when I'm going to essentially check that. So what will be my total outflow in that case now? How much is going to be my total outflow? Yes. So total price for GBP 300 GBP, right? So what will be my price for me? It will be 300,000 into 1.95. Am I right? Yes.
Yes, sir.
All right. The same thing I'm going to do over here. So I'm going to say this is 1.95. Same thing I'm going to do over here if the three different options are there. So I get these are my total price if GBP is 300,000. Now I know the probability. What is the probability? 25, 60 and 15% respectively. So what is going to be my total outflow now? So total outflow will be total price into 25%. Right? That brings me to the total amount, which is 594,900. Now to this, do I have to add any cost? Did you have any initial outlay?
The premium, we take on premium here in this calculation.
Yes. So we will have to pay interest on premium amount. Am I right?
Yes, sir.
How much is your premium amount? Yes.
0.04
0.04 into
into
0.04 per pound or per dollar? Look at the question. We have a call option which was given to us. A call option on pound that expires in 180 days and an exercise price of $1.97 and a premium of $0.04. This is per pound, right?
Yes,
Premium
sir.
of 0.04 per pound. So this is 0.04 into 300,000. That is my total premium. And how much interest I am paying? Remember, I am paying all these amount in dollars, right? So that means I have to consider rate of return of dollar, right? What is the
Borrowing rate 5.5%.
very good. So borrowing rate is in US is 5.5%. So I will have to take it at 5.5%. Okay, that comes to 660. Let me put this. So my total outflow is 594,900 plus 660. So I get 560 as my total outflow. Now, what was the question asking me? The question was asking me, out of the four options, which of the following strategies would be most preferable to XYZ Limited? So, which is the strategy which is most preferable? So,
No
XYZ
hedge.
Limited should opt for which option? The one which has got the least amount of outflow. Am I right? Yes. What is the
No
outflow?
hedge position, sir.
588, 586, 500, 605, 741 or 595. Which is the least amount?
586, 500.
586, 500. That is no hedging option, right? Should opt for no hedging option as it has least outflow of cash. Got it, everyone?
Yes, sir.
All right. I repeat once again, in this question, what have we done? We were asked in the question 4 options: a forward contract, a money market hedge, an option contract, and the fourth one was no hedging, right? So we identified because this firm has a outflow, expected outflow or expected payout which is supposed to be paid, right? So they would need 300,000 pounds at the end of 180 days. So we try to identify based on the one which has got least amount of outflow of cash. Had he been an exporter and was expecting, then in that case, we would have tried to maximize the option which is going to give me maximum inflow, right? Okay. Now, this is question number 5, where we evaluated these 4 strategies. Let us take one more question where we are going to again evaluate the options, right? And let's see if you have understood the concepts. Okay. So now let's take question number 6. Question number 6. Question number 6. Question number 6. Here we should not have any challenges with any alignment, etc. So that is the reason again I am taking it over here in the Excel file itself, right? Because there are no tables, etc. All right, we start with question number 6. A Limited of UK has imported some chemical worth of USD 364,897 from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot and forward rates are spot rate USD 1.5617 to 1.5673. 6 months forward rate is USD 1.5455 to 1.5609. Before we go further ahead, immediately you need to understand one particular aspect, that my liability, this is an importer who has a liability. His liability is in which currency? His liability is in which currency? USD. And the spot rates are given to you. USD 1.567, 1.5673. So this is basically, what is the numerator and denominator? Which currency is numerator? Which currency is denominator? Any ideas? A Limited of UK has imported. UK का currency कौन सा है? Which is the currency for UK? GBP, right? So is this USD upon GBP or is this GBP upon USD?
I think it's GBP upon USD.
No, you are told USD is 1.5617. So if USD is 1.5617, that means denominator is what? If 1.5617 is your dollar, right? That means denominator is 1. So this 1 is what? GBP. Am I right? Are you with me?
Yes, sir.
Now, what is the challenge over here? My expected currency in which I need to make the payment is in USD. And I am given the rate where my base currency is pound. So what would I need to do over here? If this is a indirect quote, I will need to convert this into
Direct.
Direct quote.
Very good. I hope you all have understood why do I need a direct quote. Because in direct quote, what I will have is, I will have dollar in the denominator, GBP in the numerator, right? Then in that case, I can easily essentially say that, okay, say for example, the value hypothetically comes to, let's say, 0.8. Then I can say USD 364,897, right, into 0.8. I can easily find what will be the pound amount, right? So that is the objective. We need to have a required currency as the base currency. It will make our life a lot easier. So I'll convert that into direct quote first of all. All right. Let's go further. The borrowing rates in UK and US are 7% and 6% respectively. The examinations, whenever this kind of information is given to you, it's always better to write it down over here somewhere. UK, US. What is my borrowing rate? And what is my deposit rate? Right? So borrowing rate in UK and US, how much is that? Borrowing rates in UK and US are 7% in UK, 6% in US. And then deposit rates are 5.5% and 4.5% respectively. So 5.5 for UK and 4.5 for US. right? Try to convert the literature information which is given to you. You are given these things in literature form, convert it into a simple table format. In the working itself, it will make your life a lot easier. All right. Currency options are available under which one option contract is for GBP 12,500. GBP contract size is given to us, right? So I will need to arrange based on what is going to be my dollar requirement, right? Because my ultimate objective is dollars. The option premium for GBP at a strike price of USD 1.70 per GBP is USD 0.037. So this is the premium. For call option and put option, I have a premium of 0.096. So here you have to make a decision whether you actually need a call or whether you will be needing a put option. Again, the question is this rate which is given to you, USD 0.096, this is given for what? USD upon GBP. Am I right? So what is the base currency? Base
Pound.
currency is GBP. Am I right?
Yes, sir.
Okay. So now before I go further ahead, I am going to call option means it gives me right to buy a currency. Am I right? So call option is right to buy. If I am the call buyer, I have a right to buy. I will buy which currency? Base currency is GBP. So do you want to buy GBP or do you want to sell GBP?
Sell GBP and buy USD.
Exactly. I want to buy USD, right? So I have to sell GBP, which means I will opt for put option. Are you with me?
Yes,
So you
sir.
need to be mindful that this put option or call option is not given to you in the target currency that you need, which is US dollar, but it is mentioned to you in GBP. So I need to be very, very mindful that the call option is for buying GBP and selling USD. I don't have to sell USD. I want to buy, right? Because this is sell GBP and buy USD, right? While over here, call option is about buy GBP and sell dollar. Okay, so that is the reason we will go for put option because I want to buy dollar. All right. Company has three choices: forward cover, money market cover, and currency option. Which of the alternatives is preferable by the company? Fair enough. First and foremost, what will be the forward rate? What will be the forward rate? Remember, forward cover is the easiest of the options. However, here you need to be mindful that they have mentioned the rates in dollar upon GBP, right? So you will need to first of all convert that into GBP per dollar, and then you can multiply it with, you want the bid rate or the ask rate? Do you want the bid rate or the ask rate? Yes, bid rate or the ask rate. You will be buying dollars, right? So you'll have to go by the ask rate, am I right?
Yes, sir.
So first of all, let us convert the spot rates and 6 months forward rate into indirect quote. It is currently given as, sorry, it is indirect. Let's make it direct quote. So let's start the solution. Okay. All right. So spot rate that is given to us is, this is USD to GBP 1.5617 and 1.5673. Okay. And forward rate, what is the forward rate? 1.5455, 1.5609. Okay, so this is the indirect quote. I want to make it direct quote. So how do I go about it? Yes. How do I make it direct quote?
So 1 upon ask and 1 upon bid.
Very good. So here, remember first and foremost, direct quote is going to be GBP upon USD. Am I right? GBP upon USD. All right. So now this is my bid and my ask. Now we have learned earlier also, we have learned that together, right? How to convert indirect quote into direct quote. So first of all, it will become the reciprocal, and then bid reciprocal will basically become the ask rate, and ask reciprocal will become the bid rate. So here my bid rate is going to be 1 upon whatever is the ask rate over here. Am I right? 1.5673. Similarly, I will see over here 1 divided by ask needs a bid rate, right? Are you with me?
Yes, sir.
Yes, everyone. Now, after solving it, if I am not confident what is happening, then how can I normally check? Normally, you will find that bid is always going to be lesser than the ask price, right? Because that is the price at which customer is selling to the bank. So spread always has to be there, isn't it? So ask is always going to be higher than the bid price. So I have done it correct? Yes. Again, same thing I need to do for forward rate also. Check it out. Bid rate it is 1 upon ask rate, and for ask it is 1 upon bid rate. Are you all with me? Shall we
Yes, sir.
start with the options now?
Yes, sir.
All right, let's start. So what will be my first option? First option is forward cover. So how much will be my outflow or amount payable? Outflow in what is my home currency? My home currency is GBP. I am a firm in UK, remember? So how much is going to be the outflow for me? I need
Sir,
to arrange
ask
for
rate.
I need to arrange for how much? 364,897. Now you please be mindful. The very reason the faculty or the examiner has essentially said this particular value is, and here the major error which happens is on the human error part. Remember, you have learned casting error. You're all chartered accountants here. So we know that particular aspect, right? So please be mindful of it. So 364,897 into, I need to buy this USD. So I'm going to buy that at what rate? Forward cover will be available to me at what rate? 6470 or it will be 6403. I have to buy dollars, right? So I get 236,102.88. Right? If you still want, I can wait a moment. Let me write it for your easy reference. 764,70,398. Okay. This is my working part. All right. Now, second option. Second option is money market cover. Money market cover. Okay. Now here, in case of money market, what is going to be my obligation? Do I have a liability or asset? Sorry.
So I have a liability.
Okay. So
We'll need to create an asset.
Exactly, yes, very good. So I have a liability. Liability is in dollar 364,897, right? So I need to create an asset which will have maturity value of 364,897 dollars. Am I right? So I
Yes,
need
sir.
to invest over here in dollars. How much do I need to invest over here?
Present value of
Present value. Present value. So how will I find the present value? 364,897 divided by, I need 1 plus R. Have they given me the rate of interest? The borrowing rates in UK and US are. Now here you can see they have not said this is 180-day or 6-month rate, right? So this is obviously
per
the
annum.
rate which is annual. Am I right? Per annum. So I am investing over here in dollars. So dollar mein, what is the deposit rate you are going to get?
4.5.
4.5, right? So it is going to be 1 plus 4.5% divided by, I need this to be after which period? 6 months, right? So it is divided by 2. Are you all with me? So I'll get a certain number over here, right? Fair enough. Now, in order to do that, what I need to do is, I need to borrow today in pounds. How much pounds do I need to borrow? So here, whatever is the amount, what is this amount coming to? 364,897 divided by 1.0225, right? So how much is that coming to? You take over here.
Spot ask rate.
It is 364,897 divided by 1 plus 4.5% divided by 2. So how much is that coming to? 356,867, right? 356. This is 356,867.48, right? Now I need to borrow. So how much pound I need to borrow? What is the rate I will apply over here? I want to convert dollars into pound.
GBP. Spot rate.
So what is my spot rate over here? Spot rate, I already have it over here, right? Yes, spot rate is what? GBP per USD. I am going to buy USD, right? So
Ask rate.
ask rate. So it is going to be 356,867.48 into 0.6403278. That is the amount of borrowing I'll have today in pounds. So that comes to this into 6403278. So that comes to 228,512, right? And then on that I will have to pay interest. Interest at what rate? Into borrowing in UK is at
7%.
1 plus 7% for the entire year
6 months.
divided by 2, right? It is for 6 months. So that comes to 236,510, right? So I'll get over here 228,512.2 plus interest at the rate of 7% for 6 months, right? 7% per annum. So total comes to 236,510. Now let's put this over here. Okay. So how much is going to be my outflow. So let me find out first of all my liability after 6 months. USD is how much? 364.97, right? So this becomes the maturity value of my investment. So how much investment is needed? Investment required in USD today will be how much? 364,897 divided by 1 plus 4.5%
Divided by 2.
divided by 2, right? Okay, so I got 356. Now, how much do I borrow? Borrowing today,
GBP per dollar asset.
GBP. How much will that be? 356 into, what is the rate? I am going to be, today the rate is 0.64003,278. 6, I get 228,512.2, and then I will say add interest on borrowing at 7%, right, for 6 months. So that will be this into can just say directly it will be 7% divided by 2. So I'll get the total outflow as 236,510, right? That is my outflow in GBP. So now I have found out the two options, forward cover, and then I have found out money market cover. Now, third option remains. Has everyone got this? Right?
Yes, sir.
Okay. So currency option. What is my currency option over here now? Currency option is, currency options are available under which one option contract is for GBP 12,500. The option premium for GBP at a strike price of USD 1.7T per GBP is 0.037 and USD 0.096 put option for 6 months. First and foremost, do you need a call option or put option?
Put option.
We need a put option. So we'll essentially mention that we need put option, right? So we are going to mention over here that first of all, what I need is a put option. Options are expressed in GBP and since, what is the name of the company? A Limited. Since A Limited has to pay in USD, it means they will buy USD and sell GBP. Am I right?
Yes, sir.
Okay. Thus, A Limited will need call option or put option?
Put option.
Put option. The brackets, this is basically for your reference, sell GBP, right? Okay, all right. So now let's start. Amount, first of all, So liability after 6 months in USD is 364,897, right? How many contracts will I require? First of all, I need to have that, right? Because 12,500 GBP is the size of the contract. So how many units are allowed in option contract? How many units are allowed in option contract? 12,500. But this is GBP, right?
Yes.
This is GBP. Yes, units are allowed in contract is GBP. Now remember here, my target currency is USD. The option contract is mentioning GBP. So obviously I cannot do 364 divided by 12,500 to determine how many contracts will I require. I need to convert this value into USD, right? How much will be the USD? What is the exercise price? Do I know what is the exercise price?
So $1.7 per GBP.
Exactly. In USD will be equal to GBP into 1.70, which is my exercise price, right? So it's going to be 12,500 into 1.70. So I get 21,250 as the USD covered in each contract. So how many number of contracts will I require now? Number of option contracts required. How many? USD is 364,897 divided by 21,250, right? So I'll have 17.17 number of contracts, right? How did I get this? How did I get this? I repeat once again, this is nothing but 364,897 divided by 21,250. Okay. What about the uncovered position? Have they mentioned something about the uncovered position? Because obviously 0.17 means something is going to remain. So what are you going to cover that with? Are you told anything about that?
No.
Currency options are available under which one option contract is for GBP 12,500. Option premium for GBP at a strike price of USD 1.70 per GBP is USD 0.037 call option and USD 0.096 for 6-month period. Now I don't have anything mentioned about the remaining part. But are you told that you want to take the risk for the remaining? No. We have not been told that he wants to take a risk. So in that case, what will we do? What will we do in that case? Yes?
फॉरवर्ड में जो स्पॉट रेट हैगा उससे हेज कर लेंगे.
Yes. So we will hedge it with the forward rate, right? Today for the remaining, which is the balance amount, right? Okay. So first and foremost, how much will be the amount or by options? So how much will that be? Is equal to 21,250 into 17. So this is what is going to be covered. How much do you need? You need 364,897. So what is the balance? 364,897 minus 361,250. So 3,647. So this USD will need to be covered by forward. Right? Okay, are you all with me? Now remember, we have identified this in USD terms, all three. Right? You have identified this in USD terms. I need to cover this in GBP now. I need to find what will be my total outflow in GBP terms. So what is going to be my total outflow now in this particular case? Yes?
So premium रहेगा for the contracts we have taken for the option.
Can I find over here? Yes, dear. Premium definitely will be there. That is my cost. So that will definitely be there. Okay. So how much will be this covered at? It's 361,250 USD. Right? It will be at the exercise price, right?
Yes.
So this is going to be this divided by 1.70. Am I right?
Yes, sir.
So I get 212,500. What about 3647? What about 3647? This has to be at forward rate, right?
Yes.
So which forward rate are you going to take? You want to buy USD. So it's going to be
Great.
6470398. Are we right?
Yes, sir.
So it will be at forward rate equals to 3647 into 0.6470. We have already established these rates, right? I hope everybody is able to follow that. Why am I taking ask rate? Because I will need to obviously buy USD in the forward, right? If you're not able to follow, you can again go back to our option one as well. That is what we had done in the option one, remember? So it is very identical to that. The only difference being the amount you have taken is lesser. So this is my total outflow, but I need to add one more thing, and that is add premium. How much premium will be paid out? Premium on put option. So how much premium on put option? Because this I will have to have a outlay right away. So how much is going to be my premium? We are told it is 0.0.
37.
This is premium is how much?
0.096.
0.96, right? This is 0.096 in US dollar terms. 0.96 into $0.096, right? For every GBP. So I will need to multiply this with 212,500. Am I right?
Yes, sir.
212,500. Remember, premium you will pay only on the cover of the cover which you have obtained, not on the uncovered position, because that amount is not covered by your options, right? Okay. So how much is that going to be? On 2,12,500, you are paying this in dollar terms. So
20,000
into 212,500. So I get 20,400, which is the USD being paid as premium. Am I right? So what is going to be my total outlay? I have to convert this, right? I'm going to pay this when?
Yes,
I have
sir.
to pay this 20,400 today, right? In the spot. So what is my spot rate? What is my spot rate? Sorry. 20,400 I can buy at what rate?
Ask rate of spot.
Ask rate of spot, right? 6403278 into 0.6403278, right? So now I get my total outflow, which is 227,922. Okay, now between the three options, which are the three options I have? 236,102, 236,510, and then I have 227,922. So which option is the cheapest with least outflow? Yes. So A Limited should opt for
Options.
options as it has least amount of outflow, right? Got it, everyone? All right, now we are going to do the next question, which is about computation of swap points. So before I start, let me start first of all with the basic introduction of swap first of all. Are we all through with this? Right? Okay, now let's go to swap. How does a swap work basically? So what is the meaning of swap first of all? Yes, what is the meaning of
Exchange
swap?
something,
Exchange of
rates or currency,
exchange of
interest
can
rate.
have swap basically can happen for some commodities. Like say for example, I have on the like you might have heard about barter trade, right?
Yes, sir.
Say I am a farmer who is growing let's say wheat, right? And you have been growing rice, say for example, right? This is me and this is you, right? Now obviously I need some rice as well. So I take certain quantity of wheat and essentially exchange with you for quantity of rice. That is normally considered as exchange or a swap, right? I am essentially swapping wheat for rice. But when we talk about swap over here, we are not just talking about some barter trade, etc. What we are talking about is exchange of some obligations. Now, these underlying obligations could be in the form of, let's say, some forex currency, right? It could be in the form of maybe interest rate obligations, right? It could be some commodities, like we saw over here, commodities. It could be some commodities, or obviously it could even be for some equity or stock, etc. Now, here we are going to essentially focus on the swap of foreign currency, right? So, first and foremost, what do you mean by a currency swap? Now, let's say, for example, I have how does currency swap? So, what? Sorry. Say, for example, we have A Limited over here in India. Okay. Now, A Limited in India has a subsidiary. A Limited, they have a subsidiary in US, right? Similarly, there is a company called B Limited. There is a company which is there in US. Okay, and they have a subsidiary B Limited, right? It's a subsidiary of B Limited. Subsidiary is in India. I repeat once again, basic facts. A Limited is a company which is incorporated in India, right? And it has a subsidiary which is in US, right? So A Limited has a subsidiary in US. Similarly, there is a company B Limited which is in US, has a subsidiary in India. So you can say here there is a holding company in India, subsidiary in US, while here you have a holding company in US and subsidiary in India, right? This is subsidiary in India. All right. Now say for example, hypothetically, if A Limited wants to essentially provide some money to A Limited subsidiary, which is, say for example, it is USD 100,000. Okay. A Limited subsidiary in US is in need of money and A Limited wants to provide that particular money to the subsidiary. Similarly, even B Limited subsidiary wants to provide some USD 100,000. Right now, I'm taking the example in the same currency. Okay, though these are two international countries, they are taking the example in the same currency, just for you to understand that both of them basically are in need of providing certain amount of finance to their respective subsidiaries. Right now, let's say for example, on today, the exchange rate is $1 is equal to, say for example, rupees 50 for calculation purpose. Okay. So say for example, $1 is equal to rupees 50. So in that case, A Limited has to provide basically 50 lakh rupees to A Limited subsidiary, because they will essentially buy USD, they will buy dollar, right, by selling rupees, and they will provide that to their A Limited subsidiary in US. Similarly, B Limited over here has USD 100,000 and they need to provide over here rupees 50 lakhs, right? So they will convert their dollar into 50 lakh rupees to provide it to B Limited subsidiary. Now there can be one easier way out. If A Limited and B Limited respectively, the subsidiaries, can go to the banks in their respective countries where they are there. So A Limited in US and B Limited in India, right? If they could essentially reach out to their local banks and say, we want a loan of $100,000. So here B Limited can say probably I want 50 lakh loan, and A Limited can say I want a loan of $100,000. And if the banks respectively provide them that loan, then it is great. They don't need to worry about it, right? Because then the exchange rate conversion, etc., will not apply, and A Limited will directly provide whenever it has to transmit some money. The challenge arises A Limited and B Limited subsidiaries. The subsidiary companies, they do not have strong balance sheets. So obviously bank will not give them the loans. So it is the responsibility now on the holding companies to provide money to the subsidiaries. I repeat once again, subsidiaries do not have strong balance sheets that they can reach out to their respective local banks for the loan. So they have to depend on their holding companies to provide them the finance. Now holding company has two options available over here. Either it essentially, the holding company A Limited takes a loan, right? If it does not have the finance available, it takes the loan and then it transfers the money to A Limited subsidiary, right? Alternatively, it can essentially reach out to another person who is in need of the same, right? So what A Limited and B Limited, the holding companies, are getting in, what they do is they are going to essentially swap the loans. So B Limited reaches out to their bank in US, right, and procures a loan in dollar. Similarly, A Limited in India reaches out to bank in India. Procures a loan in rupees, right? How much? They are taking 50 lakh loan. Here, they are taking a loan of $100,000. So basically what they are doing is they are trying to help out each other. What they will do is A Limited and B Limited are entering into an arrangement wherein A Limited is essentially saying to B Limited, you take a loan over there of 100,000 USD and provide it to B Limited, my subsidiary. Sorry, provide it to A Limited, my subsidiary, right? So you provide this dollars to my subsidiary. Similarly, I will take loan of 50 lakhs over here, right? I will take this loan of 50 lakhs and provide it to your subsidiary. So what is the net effect? You wanted to essentially transfer this $100,000 to your subsidiary, right? So I have done that for you. And what is the advantage over here? Can you see the advantage over here? A Limited, a company in India, has got an obligation in Indian rupees over here. A liability is created in their books in Indian rupees. Similarly, B Limited is a US company and they have created a liability in dollar, which is their home currency. So they both are having obligations in their home currency. They wanted to provide the funds to their respective subsidiaries, and they have done that without incurring the exchange loss or having to actually pay for the margins to the bank, right? Because banks are obviously not going to provide those currencies to you for free. They're going to charge you. So instead of paying that, they have directly done this particular transaction wherein both of them are able to swap their obligations, right? They have essentially exchanged loan over here. So A Limited has taken a loan, provided the money to B Limited subsidiary, which is in India. They have provided 50 lakh rupees. B Limited in US has provided the same amount to A Limited, which is a subsidiary of A Limited in US, right? Now, principal has already exchanged hands. You can see both of them have taken the respective loans. They have already exchanged. Now the question arises, say for example, this is a 1 year arrangement only. Okay, we are going to take this as a 1 year arrangement only. 1 year arrangement. So for 1 year arrangement, say for example, whatever is the respective interest rate. So let's say for example, in India, interest rate is at 9% on loan. In US, interest is, say for example, at 4%. Okay, so what will happen over here? B Limited in US, which has got a loan in its books at 4%, it will have to pay interest of 4,000, right? So it will pay to its bank and it will recover that from A Limited. So A Limited is going to pay that interest. A Limited subsidiary, which is in US, is going to pay this $4,000 back to B Limited so that they can essentially pay to the bank. Similarly, B Limited subsidiary will pay interest in INR terms to A Limited. Sorry, how much? That will be 50 lakh into 9%. So that comes to 4.5 lakh rupees, right? Rupees 4.5 lakh. So they will transfer that money to A Limited India and then A Limited India will pay to the bank. Now, this was only a 1 year arrangement. So after the year, what should happen? First, what happened? You took the loan. Both the holding companies took the loan, right? Then they exchanged the principal amounts. This was the start. Then interest. At the end of the first year, interest. So who paid the interest? Subsidiary paid to the cross-holding, right? Cross-holding, why am I calling it cross-holding? Because it is the holding of B Limited over here, right? And B Limited subsidiary is paying to the A Limited holding. So it is paying the interest back. And then now, since it was a 1 year arrangement only, I need to do the repayment. So the original loan which was borrowed, that B Limited has to essentially transfer that money back to A Limited. So B Limited subsidiary will now, along with 4.5 lakhs, will also pay 50 lakhs back to the A Limited. And in the same way, In the same way, A Limited, which is a subsidiary in US, is also going to pay interest plus the principal which was there, right, back to B Limited US holding company, and the transaction closes. So what was the objective of this particular entire swap? You will have your exposures basically in your own home currency. You essentially save on the conversion cost, right? Now, the question that arises is, since, say, for example, interest, you can do the calculation interest because the local is subsidiary, B Limited subsidiary in India is paying the interest. So I don't need to do the conversion again, right? For interest, I will just pay it back in 4.5 lakhs. Same goes for my repayment amount of 50 lakhs as well. This entire process is known as currency swap, right? This is for 1 year. You may have thereafter for 4 years, 5 years, 10 years, depending on whatever is the tenure agreed between the two parties. Okay? Is that clear? Yes? All right. Now, let us take it's 8:26. We will need some time. Shall we take a break now before we start with the sum?
Okay.
Yes.
So let's take a 10 minutes break and then we will start with the practical sum. All right. So the example that we had just now taken, right? The same example, what I have done is I have tried to reduce that into kind of a question, right? Trying to identify what will be the benefit of swap to the respective companies. So A Limited is an Indian company with subsidiary in US and looking to raise USD 100,000 for funding its subsidiary. It can borrow at the following rates: $8% and rupee 12%. So if it takes a dollar loan, it will cost it 8%. And if it borrows in rupees terms, then it will have to pay 12%. Similarly, B Limited is a US company with subsidiary in India and looking to raise rupees 50 lakh for funding its subsidiary. It can borrow at the following rates. That is, if it borrows, it will cost $6% to B Limited. Now, why B Limited will cost 6% only? Because, it is a local company, right? Foreign companies generally essentially end up having a higher cost, right? So, it is going to have a cheaper dollar loan, but rupee loan will be obviously dearer compared to A Limited, right? Spot rate given is $1 is 50. So assuming swap is for 1 year, compute savings, if any, of currency swap to the two companies. Now, right now, we are going to assume the spot rate and even the forward rate for 1 year, forex rates are going to be remaining at $1 is equal to rupees 50. Then in that case, here, what is the benefit of the swap to the two parties? Yes, what are they going to do? So let's see that. So here I have A Limited, right, in India. Then I have B Limited in US, right? A Limited has a subsidiary in US, right? This is a subsidiary. This is holding company. B Limited is a holding company in US having a B Limited subsidiary in India. This is the holding company. This is the subsidiary, right? Now, as we mentioned earlier, let's say if they both enter into a swap, then what happens? So A Limited is going to borrow rupees 50 lakhs, right? It's going to borrow rupees 50 lakhs, which is equivalent to 100,000 USD because the rate given to you is $1 is rupees 50, right? So it will borrow 50 lakhs and give it to B Limited. B Limited is going to borrow over here 100,000 USD, right? And will give it to A Limited, right? So here you can see principal has already exchanged hands. Nobody is at win, nobody is at loss because conversion rate would have been the same. So they are both happy with it. Now, a year later, they have to pay interest on it, right? Now, A Limited has taken a loan in INR, so it is going to pay 12% to the bank, right? So 50 lakhs into 12% is how much? 6 lakhs. So B Limited has to give back the interest over here of 6 lakhs. Are you with me?
Yes, sir.
Similarly, A Limited, the subsidiary, has to pay back the interest to B Limited. That will be at what rate? That will be at what rate? Remember, US company can borrow at 6%.
3%.
So that means it will have to pay 6,000, right? So it will pay $6,000 to B Limited. And at the end of the year, then they again exchange the obligations. So A Limited will again pay back 100,000 back to B Limited, and B Limited subsidiary is going to pay back 50 lakh rupees. Now the question that arises is, sir, We did this process, but what is the saving for A Limited? So now, in order to understand the savings, let us first of all see the situation if there is no swap, right? What happens if there is no swap? If no swap, A Limited would need funds in US, right? Basically, because it has to provide USD over here. So they would borrow how much? 100K, that is $100,000, right? And they have to pay how much interest rate?
8%.
8%. So their outflow, if there is no swap, is $8,000, right? Now that the swap has happened, so what is the cost of A Limited?
6,000 when swap happened.
When swap happened, interest is 6,000, right? So what is the savings for A Limited over here?
$2,000.
$2,000 is the savings for A Limited. Now the same process, let's repeat even for B Limited, right? Let's repeat this for B Limited also. For B Limited, what would have been the interest? Because it required INR, right? It had to borrow in
15%.
INR terms, and INR loan would have costed them how much?
15%.
15%. So that is 50 lakhs into 15%. That comes to how much?
7,50,000.
7,50,000. And because there was a swap, so they paid how much?
6 lakh.
Right? They paid 6 lakhs. So what is the saving for B Limited?
1,50,000 rupees.
1,50,000 rupees. Right? So you can see over here, both the companies are benefiting due to swap. Obviously, the benefit will not be of the same magnitude, because if you convert this into, say, for example, dollar and INR respectively, this 2,000 into 50 will become 1 lakh rupees. 1,50,000 divided by 50 will be $3,000. So that's okay, but both are benefiting out of it, this arrangement, right? And that is the reason currency swap becomes a very, very good option, especially when you are borrowing international, right? Is that clear to all of us? Okay. Now, in the assignment sheet, we have question number 9. So let us look at question number 9. I hope this concept was understood by one and all. Right? Now, let's take question number 9. Now, again, in question number 9, I should not be having any challenges with the alignment part. So that is the reason I'm again taking it over here. Right? Okay. Is this visible to everyone? Let's start. So Drill Dip Incorporation, a US-based company, has won a contract in India for drilling oil field. The project will require an initial investment of rupees 500 crore. The oil field, along with equipments, will be sold to Indian government for rupees 740 crore in 1 year time. Since the Indian government will pay for the amount in Indian rupee, the company is worried about exposure due to exchange rate volatility. You are required to construct a swap that will help the drill dip to reduce the exchange rate risk. Assuming that Indian government offers a swap at spot rate, which is $1 is equal to rupees 50 in 1 year, then should the company opt for this option, or should it just do nothing? The spot rate after 1 year is expected to be $1 is rupees 54. So you can see over here, dollar is going to appreciate, or in other words, rupee is going to depreciate. Further, you may also assume that the drill dip can also take a US dollar loan at 8% per annum. All right. So what is going to happen over here? Yes, construct a swap that will help drill dip to reduce the exchange rate risk. So what can it do? First of all, what it will do is it does not have 500 crore rupees, right? It has an initial investment. So it is going to essentially, first of all, swap a US dollar loan today at an agreed rate with any Indian party, right? To obtain Indian rupees to make initial investment of 500 crores, right? So it will essentially swap a US dollar loan so that it can be converted into 500 crores. After 1 year, what it will do is it will swap back the Indian rupees with the US dollar at the agreed rate. In such case, the company is exposed only on the profit earned from the project. What do you mean by that? Because I have already entered into a swap with you. Let's see over here. How it will go is today I have an obligation of 500 crores, right? Today, this is today, right? So 500 crores, if I enter into a swap today, that you give me 500 crores, I will give you 500 crores, right? That is basically the swap. So I am giving you 500 crores in USD and I am going to take the rupees from you, right? So since this is 500 crores and the rate at the big currently is given to you as 50 rupees, so this is essentially going to be how much? 10 crores in USD, right? So this is 10 crore USD, right, which you are giving, and you are going to receive 500 crores in rupees terms, right? This is the swap which is happening today. Now here, what is the exposure? After a year, I will essentially have to reverse this entire value, right? So I have to essentially take the 10 crore USD back and give the 500 crore rupees back. Now, that essentially provides me a good cover for which period or which amount? Only for 500 crores. I am going to receive after 1 year how much? I am going to receive 740 crores. Now remember, my swap covers only 500 crores. So for the balance part, which is my profit element, for the remaining 240 crores, I am carrying an exposure over here because that is not covered under the current prevailing option or the swap option, right? So I need to arrange for this particular 240 crores to protect myself. You are already told the spot rate after 1 year is expected to be US dollar 1 is equal to 54. So you are already expecting that there is going to be a depreciation of INR, or in other words, appreciation of USD. And I am going to be paid in rupees only because this is Indian government which is going to pay me 740 crores rupees only. All right. So now that we have constructed this swap, because that is only swap means essentially we need to have exchange of money, right? Because at the end of it, there isn't a liability which I am giving it to you or asset which I will have, right? I will need to have the same amounts. It is basically going to put me in the same position. So that is the reason we say, I give you 10 crore USD, you give me 500 crore rupees. So at the end of that, there is no outstanding obligation at either of the parties, right? So in that case, my cover is going to be exposed only to the extent of, I have an exposure only to the extent of 240 crores. 500 crores will get covered under the swap because that is my profit. Okay. All right. Now, what is further asked? Assuming that Indian government offers a swap at spot rate, which is US dollar 1 is equal to 50 rupees in 1 year, then should the company opt for this option or should it just do nothing? Right? The spot rate after 1 year is expected to be 1 USD is equal to rupees 54. Further, you may also assume that the drill dip can also take a US dollar loan at 8% per annum. Fair enough. Let's do the comparison for this second part. For the B part, remember for the A part, there is a simple swap which you have to essentially construct, right? That you are going to swap basically your USD loan into the INR 500 crores. And then in that case, your dollar obligation basically is there of 10 crores, but you got 500 crore INR that you required. Since the swap already means that you will reverse the position at the end of the year, so again I will get 10 crore USD and 500 crores I will have to pay at the prevailing rate, right? Now the challenge which arises, I have the exposure only and only for the profit element, which is 240 crores. Okay, so that is my first part, A part, which is constructing a swap. Second part, we will do the calculation. What happens when I do the swap and what happens when I don't do the swap? So first we are going to do with the swap which is on offer, right? So if I do the swap, what will happen? So I am going to have outflow today, right? So outflow today. Outflow today. How much will be the outflow today? For me with swap, I am going to have the outflow today of, remember, I have $1 is equal to 50 rupees, right? This is the rate. I need 500 crores. So how much will be the outflow today? In USD terms, yes, 500 crores divided by 50. I will get INR. Am I right? How much will that be? Yes, how much will that be? This is rupees 500 crores divided by 50. So I'll get equal to USD 10 crores. Are you all with me? Yes. So USD 10 crores. See, this is 1 crore. I need to add one more zero. Okay, so 10 crores. Okay, so this is my outflow today. What will be my inflows due to the swap? Yes, how much will be my inflows? So remember, swap is going to cover only till 500 crores, right? But that is going to be at $1 is equal to 50. So I'm going to receive back how much? Same amount I will receive back. Do you agree with me? It is basically going to be the same thing. Over here, I will receive the entire amount again in inflow. Are you with me? The inflows are going to happen when? Inflows will happen when? After 1 year. Are you all with me? Right?
Yes, sir.
Now, so swap is going to cover the 500 crores, which is what the strategy we had also mentioned, right? For the balance 240 crores, I have the exposure, which is
सर
my
ये
profit.
1 ईयर के बाद जो हमें इनफ्लो होगा वो डिस्काउंटेड नहीं होगा?
Which one, dear?
सर ये जो 10 करोड़ स्वैप आप इनफ्लो कर रहे हैं ये डिस्काउंटेड नहीं होगा आफ्टर 1 ईयर? सेम अमाउंट कैसे हो सकता है?
No. So how it happens is, my dear, when you are doing a swap, see, I have given you 10 crore dollars, right?
करेक्ट.
And you have given me 500 crore rupees. So it is at a predetermined rate that after the end of the year, I will give you back 500 crores and you have to give me 10 crore dollars back. So forex risk is belonging to whom? To the person who has respectively taken that particular exposure. So I am covered to the extent of 10 crores. Now, in this case, it is beneficial for me because my currency is going to appreciate,
करेक्ट.
right, vis-a-vis your currency. So you will still have to give me USD 10 crores, which means basically this loss on account of forex will be borne by whom? The other party. Are you with me?
Yes.
Relative will not have to bear that loss. It will be borne by the Indian government because they are the ones who are offering this spot,
Hmm.
right? So they essentially bear that particular loss to the extent of, you are correct that, sir, after 1 year, it has become now $1 is 54 rupees. So who bears that 4 rupees loss? The 4 rupees loss will have to be borne by the Indian government. I am not bothered with it. I am going to get my 10 crore back in dollars.
Okay.
Are you with me?
Yes.
All right. Now, I am going to essentially have remaining, how much remaining? 240 crores is remaining, right? I still have another 240 crores, the profit, remember? How did I get this 240 crores?
740 minus 500.
740 minus 500, I have written over here, remember? So 740 minus 500, 240 crores, which is my profit element, that I will have to convert. At what rate? Because there is no cover which we have got over here. Swap was not there for this one. So this I will have to cover at what rate?
54.
84.
Which is going to be my rate at that particular time, right? So 54. So how much will this be? This will turn into how much? Equal to 200.
4.45 crore.
This is 5, 2 crore 40 lakhs, 24, 240 crores. 240 crores divided by 54, right? So this comes to, how much is this? 4 crore 44 lakh 44,444.44 dollars. Are you all with me?
Yes, sir.
Okay. Now, so my recovery is 10 crores plus 4 crores, so total 14 crores in USD terms after 1 year. But there is also cost. Remember, what is that cost? In order to give you this 10 crores at the beginning of the year, I had interest on USD loan, right? You took this 10 crore. What rate of interest? What is the rate of interest over here?
8%.
8%. You have to pay this 8%, right? Am I right? Yes or no? So the original amount of 10 crores into 8%. So I have to pay 80 lakh rupees, 80 lakh USD as interest. So now, please note, this is an outflow. This is inflow. This is inflow. What about interest on USD loan? Is this inflow or outflow?
Outflow.
This is also an outflow, right? So what is going to be my net inflows? So what will be my net inflows? Net inflows. Put numbers over here, or A, B, C, D. Okay, this will help us. Okay, so what is my net inflows over here? My net inflows are B plus C minus D minus A also. Am I right? Yes. So it is 10 crore plus 44 minus interest minus original outflow. So I'm going to make 3 crore 64 lakh 44,444 USD as net inflows. Are you all with me? Yes. So if I want to calculate the percentage, this will be 364 on outflow of 10 crores. Am I right? Yes or no?
Yes.
USD. Now this was with swap. What happens if there was no swap? What happens when there is no swap? What will be the change? If there is no swap, then what will happen? No swap. Then outflow today remains 10 crores. There is no change in that. then there is no question of this swap also coming back. Are you with me?
Yes,
Yes,
sir.
sir.
So this entire thing goes away. You are going to now sell how much? 240 or entire 740?
740.
Entire 740 will have to be sold by you. So that is going to be 740. So I get 13 crores. So I get 13 crores, 70 lakhs as the inflow. Interest on USD loan, I will have to pay interest or I will not have to pay interest because I'm not going
No
for.
interest.
I'll have
No
to pay
interest.
interest, right? Right? I'll have to pay interest. Am I right? So now, what is going to be B plus C minus B minus C minus A equal to 1370 minus 80 minus 100. So my realization over here net inflows is 290. So given the two options, which one would you opt for, swap or no swap? Yes, to do the swap. With swap, your inflow is 364, 3 crore 64 lakhs. Don't do swap, 2 crore 90 lakhs. So which option is better?
Swap.
We are talking about inflows, not outflows. So,
Swap, sir.
so drill dip incorporation should opt for taking swap as that would give additional net inflows of USD. How much? USD 3 crore 64 lakhs minus 2 crore 90 lakhs. So 74 lakhs 7,407.41 dollars. Okay, got everyone? Yes, got it everyone? Okay, now we will go to the next topic, which is forward contract. How the forward contracts are concluded, right? So what are the various options available for forward contract? So far, what we have considered whenever we were calculating is that if you enter into a forward contract, the parties to the contract would essentially honor it, right? So there was no other possibility which we had considered. But practically, that is not the case, right? Practically, what will happen is you have a contract in place. So say, for example, this is the forward contract, right? You have started the forward contract over here, and this is the maturity, or you can say due date of the forward contract. Now, what are the options which are there? First, forward contract requires you to essentially deliver, right? Deliver the respective things which you are obligated to. So, say for example, delivery. Okay. Assuming my obligation over here is to deliver a particular currency. So I have in delivery option, I have three options over here, right? A, B, and C. What are the three options? First of all, I will deliver on maturity, right? So I deliver on maturity. Now, let's give some example to it. So say for example, I had purchased a forward contract. I purchased a forward contract of USD 100,000, right? At rate of $1 is equal to 75, right? So what is the meaning of this? Let's say this is a 3-month contract and this is the termination of 3 months, right? So this is 0 period starting, 0 period, and this is 3 months. Okay. So on maturity, you are required to buy $100,000 because this was buying the forward currency. You needed that. So you have entered into the contract where you are going to buy US dollar 100,000 at 1 is equal to 75. So on maturity, bank is required to deliver US dollar 100,000 to you, right? And you have to pay to the bank. So on maturity, let's say this is A Limited. So A Limited has to pay to the bank. How much? 75 lakh rupees. And bank is going to in turn give $1 lakh to A Limited. This is the obligation which is there under the forward contract. So on maturity, A Limited pays 75 lakhs to the bank. Bank will give $1 lakh to the A Limited, and the forward contract is terminated, right? It comes to conclusion. Second option is, what if I receive money early? So there is early delivery, right? Between this period, that is prior to 3 months termination, I am essentially making early delivery. So I essentially say that let me have 75 lakhs after 2 months. So I am telling after 2 months that let's prepone this particular delivery. I am going to pay it to you today instead of 3 months later. So I am paying after 2 months instead of after 3 months. Then what is the situation? Or there is a late delivery on my part. What does that mean? I am not paying you on due date, that is after 3 months. Instead, say for example, due to some oversight or some challenges at my end, I am paying you, let's say, after 1 week after 3 months. So there is late delivery on my part. These are the three different ways in which my contract can essentially come to conclusion with respect to delivery part. Right? Now, it is quite possible there is also another way in which my contract may essentially get impacted. What is that? It is cancellation of the contract. What do you mean by cancellation of the contract? What do you mean by the cancellation of the contract? Here also, I can do cancellation on maturity, or I can do early cancellation. Or C, I can do late cancellation. We will obviously see the impact of each of these options, right? But before that, I just want to establish what are the different options which are available. And then I will take one example wherein we essentially look at what is the possibilities and what are the associated costs which can be there, right? Then third is extension. So in this particular case, for example, let's say after 2 months, I realize that maybe the party at the other end for whom I wanted to buy this currency, foreign currency, to pay them, that obligation is not prevailing anymore, or some other better arrangement has come through. So I want to cancel my contract. So I can do that cancellation on maturity, or I can do early cancellation, or I can do late cancellation, right? Why late cancellation? Probably I forgot or whatever, so it happens a late cancellation. Similarly, I may also have a change in my needs wherein I say I want to extend my contract instead of after 3 months, because my party has conveyed to me they'll not be able to pay after 3 months. Instead, they will pay to me after 4 months. So let's say they say that they are going to pay me after 4 months from the original date. Now, as a result of that, I need to extend the forward as well. So I have again 3 options over here also. What is that? Again, on maturity, I can do extension, or I can do early extension. If I know that party has communicated to me and I can do that prior to 3 months, then I go for early extension, right? I can arrange for the same, or late extension, right? These are the various options under which my contract, the existing contract, can be brought to an end. Let us understand now with one example. Let us now understand with one example. Say, for example, I'm going to start right from scratch. Okay, so let's say, for example, A Limited is approaching the bank. Okay, that I want a forward cover. Now, before we start, let us make some assumptions, or you can say the prevailing information. So, USD requirement of the contract value, or in contract value, is dollar, say 1 lakh. Okay, then spot rate is, say, for example, $1 is equal to 80 rupees. Okay, further, now I am just making one assumption over here, and that is that bank margin is rupee 0.20 per dollar. Okay, now A Limited wants $100,000, so it reaches out to the bank, right? And bank gives you a foreign currency cover, that is a forward cover. Now, it's never a single contract with the bank, right? Bank will always enter into 2 contracts basically. So bank is going to reach out to some other forex dealer or banker, forex dealer or bank, right, in order to procure a back-to-back forward cover, so that they are in a position to deliver the $100,000 required by A Limited 3 months later, right? So say, for example, here bank is going to get as per interbank rates, right? What is interbank rates? That is the, again, you have the same bid and ask concept, right? Bid and ask. Say, for example, the current prevailing rates in the interbank is, let's say, 70, 80.20 and 80.50. Okay, this is the interbank ask rates, bid and ask. This is the bid rate. This is the ask rate. Now, considering bank margin is 20 paise per dollar, right? And these are the dollar rates basically. These are the dollar rates, right? Rupee per dollar. in the interbank rates. So what will be the rate which bank will charge to A Limited? If bank, remember this is the bid rate, so this is the price at which you sell. The interbank rate is 80.20. Is the bank going to give it to you at 80.20 or will it charge additional 20 as returns? Yes.
Bank will charge additional 80.40.
So it will not be 80.40, it will in fact be 80. Am I right? Why 80? This is the price, bid price means this is the price at which bank is going to sell to that particular dealer, right? So from bid, you will subtract 20 paise and you will pass on to the customer how much? 80 rupees. Are you with me?
Yes, sir.
On the other hand, if it is ask means this is the buy rate. So if bank is buying at 80.50, bank is going to give it to you at what rate?
80.70.
0.70. ये समझ में आ रहा है? Is this clear to everyone?
Yes.
Very
Yes.
important that we understand this concept, right? Because it is not just one contract in isolation. You have to understand the system over here that there will be a back-to-back two contracts. Are you with me? Okay.
Yes, sir.
Now, at the initiation, since I have already entered into this agreement, right, and we are entering into a forward agreement, say at $1 is equal to 80, right? So here I am going to essentially sell US dollar. A Limited is an exporter. Okay, A Limited is an exporter. So it is going to sell $1 at 80 rupees to the bank, and bank has then essentially obtained the cover from the other forex dealer or banker at 80.20. So it will take the dollars from A Limited and it is going to give it to the other forex dealer. In the process, it is going to make a margin of how much? 0.20 into $100,000. So it will make how much? 20,000 rupees. Am I right? Okay. Now, logically speaking, A Limited needs to honor their agreement, right? A Limited needs to honor their agreement. But what if A Limited fails to honor their agreement? Then what happens? If A Limited fails to honor their agreement, then what happens? Yes. Is the bank going to essentially crib about it because you are asking for cancellation or extension or you want to deliver the currency earlier, etc.? No, bank is going to be happy about that as well. Why is that so? Because they will have to do now a second transaction. How do you essentially offset a forward cover? By taking an opposite
A
cover. Right?
positive position, taking a opposite position.
Yes, by taking an opposite position. Right. So here, what bank is going to do is, bank is going to thereafter, say for example, A Limited exporter is reaching out to them that I cannot, let's say, they say that I cannot fulfill this contract. Okay. Let me give you a simple example of cancellation. Okay. Let's say I am saying that I want to cancel the contract. Okay. Then what is the bank going to do? Bank is not going to cry and crib about it, right? Because what bank will do is, bank is going to say, okay, now I have already entered into the contract over here. So as a result of that, I have to pay over here $100,000. Now, in order to close that position, I will have to essentially buy in spot rate. Let's say this cancellation is happening on maturity date. Okay, on maturity date. To keep it simple to start. So on maturity date, now the rate, prevailing rate, whatever is there, I will need to essentially, first of all, close my position, right? How do I do that? Bank is already going to, essentially, bank has to sell to the forex dealer. At what price? At 80.20, because that is the rate at which they had agreed. Now, say for example, the new spot rate after 3 months. 3 months later, the spot rate is $1 is equal to 80.50. Okay, spot rate is 80.50. So you will have to buy from the market. Yes.
Yes, sir.
Bank is now going to essentially buy $100,000, right, at 80.50. Now, since this cancellation is happening at your behest, it is as good as you are buying this 100,000 USD at 80.70. Am I right? Because I am
Yes.
doing this transaction on your behest. So I should get my 20 cents margin for doing the transaction. Okay. Now, what this does is, it is going to essentially offset your position. Your contract is cancelled. So what are the charges for you now? What are the charges for the A Limited, the exporter? So A Limited has to pay when it entered into the forward contract. When it entered into forward contract, it will have to pay 100,000 into 0.20 per dollar, right? So that is 20,000 rupees. This was for entering into the forward contract, right? Because that was the bank margin. Now that you want to cancel the forward contract, right? Cancel the forward contract. So bank has to take an opposite position. They had to buy this in the open market at 80.50, right? So again, first of all, bank margin will come into place. That is again going to be 100,000 into 0.20. So we'll have to again pay rupees 20,000. Am I right?
Yes, sir.
These are the charges which are there. Now, originally, pay attention now. Originally, you had entered into a contract that you will sell. You will sell how much? You are going to sell 100,000 at 80.2. Am I right? So you are going to pay to the bank how much? At 80.2, you are going to sell USD to the bank, and now you are buying at 80.70. The same USD you are buying at 80.70. Into 100,000. What is this? This is the price differential. So there is another rupees 50,000 which is there. This is the loss. Am I right? This is the loss due to
Cancellation.
cancellation, right? So here again, total loss for you is 50,000. Out of this 50,000, remember 40,000 is already included or excluded. These are two independent things, right? So cancellation wise, this is, I have to pay 80.2 minus 80.70. So I have 50,000 ka loss. You can see over here, bank charges were only 40,000. Then why am I paying 10,000 more? That is mainly because of the cancellation part, right? And further, now that the bank is essentially doing this, if there is any interest element, will the bank be eligible to charge that? Will the bank charge any interest? Because say, for example, this cancellation is happening on, let's say, on 1st of December, okay? And you are essentially going to pay them back on 4th of December. So for those 3 days also, is bank going to essentially fund your transaction? Right? Bank has funded your transaction for 3 days. So will bank charge interest for those 3 days? Yes or no?
Yes.
So what are you paying over here? You are paying bank charges. Then you are also paying bank for the interest, right? Similarly, if there is any loss which is happening on account of this particular swap which is happening, right, of your position, forward versus spot. So if any swap loss is there, so you will need to pay all these costs if there is a cancellation. And you can avoid all these costs if you honor the agreement. Do you agree with me?
Yes.
सर एक बार ये सारी प्रोसेस एक बार रिपीट कर देंगे.
Yes, definitely. See, right now we are only explaining the concepts which are the relevant parts over here. Okay. So try and understand one thing. What I'm explaining over here is basically what are the things which will be involved over here in totality. Which are the factors which are involved. Right. So when you have a forward contract, I'll start right from beginning again. So A Limited is an exporter, right? And they have taken a forward cover from the bank. Bank is obviously taking a second forward cover from other forex dealer to protect itself, right? Now, bank essentially is making a margin of, say, for example, over here, as we have mentioned, it is rupees 0.20 per dollar. So the moment bank entered into this forward contract, they earned 20,000 rupees, which they are very happy to do. Now, on maturity date, A Limited reaches out and says, I want to cancel my original agreement for whatever reason, right? Now they want to cancel their agreement. Cancellation cannot happen like that only, right? Bank already has an obligation. So what is bank going to do? It is going to reverse the position because A Limited has to deliver the dollars. So in other words, in order to cancel this position, A Limited will have to buy USD in spot market to deliver and honor this forward contract. Are you with me?
Yes, sir.
Right? So here, bank is essentially going to have this spot transaction being done. Bank will buy from the spot market at 80.50, will sell it to you at 80.70, and then same dollars you will provide to the bank to complete your contract. Now, what is the cost to the A Limited for this entire transaction? Because strictly speaking, you did not receive 100,000, you did not pay 100,000, strictly speaking, right? So you wanted to just nullify the contract. But there are costs, there are charges because you had taken a forward cover. So what are the charges over here? When you enter into forward contract, bank already has its margin which is accounted, which is 20 paise, so 20,000 rupees. Similarly, when bank will again cancel the forward, remember it is again going to charge you 20,000 rupees for its forward, plus any appreciation or depreciation of the currency will also have to be borne by you. Now remember over here, I am yet not going into there is a certain rule which is there called FIDI Rule 6. I'm not getting into that. We are just talking about concepts as of now. Okay? We are not getting into specifics. We are talking only about the concepts. Now, when A Limited is essentially not able to deliver, right? It has to cover that position by way of buying that in spot market and honoring the contract. So it does honor the contract and it will have to pay now. What are the charges? What kind of charges A Limited may be expected to pay? First of all, bank is going to recover if any bank charges are there, especially the margins which are there, right? Bank has already incurred the cost, so it is going to obviously ask you to pay this 20,000 rupees for each transaction. First, when it agreed to buy the forward cover. Second time, when it essentially sold $100,000 to you, right? So that 40,000 you will have to pay. Plus, if bank is essentially, say for example, funding this, right? Bank has already bought this in the spot market, say on 1st December, paying it to you on 4th December, right? Then bank is funding this 3 days for you. Bank is going to charge you something known as interest, right? And then the third part is swap loss. So if forward exchange rate has actually gone against you, then whatever is the loss of that particular currency, that will also have to be recovered from the customer. So bank will essentially charge you all these three things. Plus any fixed charges, if any, which are levied by the bank, 100 rupees, 500,000, whatever, any nominal fixed charges are levied by the bank, then that will also have to be paid by the customer. Are you with me? This is only at the time of, we are talking about only cancellation right now. Is everyone getting this?
Yes, sir.
Okay. All right. Now, I'll bring you back to the remember, we just now started with the life cycle of a forward cover, right? So how does it terminate? By delivery, by cancellation, or by extension, right? So what does the three terms mean? Delivery essentially means that you are going to complete the contract by delivery, but when? on due date, before due date, or after due date. So if it is before due date, you say it is early delivery, right? Early delivery, or it is after due date, then you call it as late delivery. Now, the moment you say there is a late delivery, what is that going to mean? What is that going to mean?
After due date.
After the due date, right? So if it is after the due date, isn't that an automatic cancellation which happens? So say, for example, you were expected to deliver, let's say on 31st March, right? Now, your obligation was there. So as I just now showed you, even bank had its obligation, right? So you fail on due date, but bank has to honor its obligation on 31st March. Do you agree with me? Because bank has taken two covers, right? One, it has procured from the interbank market, right? And the second one, the one which was sold to you at your request. If you fail to honor your obligation, bank cannot afford to fail on its obligation, right? Bank will obviously have to close its position. And the only way to do that is by way of buying that much currency in the spot market or selling that much currency in the spot market to honor that particular contract. So here you can see bank will honor its part, but you have failed, right? Now say for example, you reach out on 15/4 and say, I have received my money only now. My client paid me late. Bank is not going to argue with you. Bank is going to say, very good, thank you. Now that you are coming up. However, will the bank give you the benefit of the forward contract at that time? Will the bank give you the benefit of the forward contract? No.
No.
Bank says, since you failed, that was automatic cancellation, right? That was automatic cancellation. And now since you have brought with this late delivery, say $100,000, so that we are going to now pay you at spot. Are you with me? So you've lost the benefit of forward cover over here. Are you with me? Now, in order to avoid this, that I lose the benefit of the spot, this cover, forward cover, I can always go for extension. If I already know that I will not be able to meet that deadline, I should be proactive, reach out to the bank for extension. Bank can essentially give me extension, in which case I can have maturity, extension on maturity, extension on prior to my maturity, or even late extension. Now remember over here, late cancellation over here, late delivery. What is late delivery? As I just mentioned, after the due date. What is late cancellation? Again, same, after due date. What is late extension? Again, after due date, right? So the moment you have after due date, automatic cancellation automatically will get triggered, right? Yes. So if it is late delivery, what is going to get triggered? Automatic cancellation plus the delivery will be at now at spot rate. Are you with me? This is for late delivery. What if there is late cancellation? There is late cancellation? What happens then? Any ideas? Any difference? We are already late in cancellation of your contract. So automatic cancellation will automatically happen. Yes or no? Am I right? Similarly, if there is late extension, then what will happen? Late extension means again there is automatic cancellation. Plus, now a fresh forward contract comes into it. Fresh forward contract comes into it. Are you with me? I repeat once again. So late delivery basically means that the contract has already, due date is already passed. So it has already expired. Contract has already expired. Since the contract has already expired, there is an automatic cancellation of the contract, right? And the second element is if you thereafter deliver, say 31st March was your due date, but delivering on 15th April, then that means since you are delivering late, you will have to now not get the cover. Forward cover rate will not be available to you. You will need to convert whatever currency you have at spot rate. It may be good, it may be less, but you have to take that particular loss. Late cancellation. So in case of late cancellation, remember you will have automatic cancellation which you already have triggered in. However, plus you will also have to pay for the charges, etc., which we just now spoke about, right? Automatic cancellation, you may have bank charges to be paid, you will have fixed charges, bank charges, the margins of the bank, and any losses which may have happened. Now here there is one important provision which is being made under the FIDAI rules, and that is that while the loss will be transferred to the customer, gain will not be transferred, right? When it is late extension. When it is late extension, gains of, so say for example, your foreign currency is actually appreciated in value in which you are dealing. So that benefit will not be passed on to the customer. But if there is any loss of currency value, that loss will have to be transferred to the customer. So customer will be liable to bear the loss, but will not be eligible for the forex appreciation. Okay. Okay. Let me take now. So as we saw over here in our example, 20,000, 20,000, 40,000 is the bank margin which you will have to pay. 50,000 is the total cancellation cost for you, which includes 10,000, which is due to further currency exposure as well, right? The difference in valuation part. And then since bank is paying earlier, it will also charge you some amount as interest, right? Let me take one example over here, very simple example. For example, I have limited, then exporter, okay, who is going to receive after 3 months, say $100,000, okay, and it goes and procures a forward cover. Forward cover is taken at the rate of $1 is equal to 80.50. Okay, spot rate is $1 is equal to 80. I'm sorry. Okay, so at the spot rate, which is 80, forward cover is available at $1 is equal to 80.50. In other words, you can see there is already a embedded premium of 50 paise per dollar, right? Okay, and see this contract has happened on, let's say, on 1st of August 2024. Okay, so the due date is essentially 3 months later, which is 1st November 2024. Okay, this is the due date. Now, in this case, say for example, if A Limited reaches out to bank for early delivery, Now, why early delivery? Maybe because the client has essentially paid me earlier. Okay, so let's say on 1st October 2024, he is approaching you with early delivery of USD 100,000. Now, what do we do? Since bank already has a forward cover available, bank will give you this particular rate, 80.50, right? However, because it is paying you 1 month in advance, bank is also going to charge you something. Okay, what is the bank going to charge you? Bank is going to charge you for, yes, any examples or any ideas? We have already considered what are the charges which are available. What is bank going to charge you? Bank will give you forward rate, 80.50. But it is going to charge you what? What are the bank going to charge you for? First of all, if there is any fixed charges, in this case, then bank will charge you that cost, right? Further, if any swap loss is happening, what do you mean by swap loss again? Because of the difference in the forex rates. Now, basically, what this means is if you are going to prepone by 1 month, it essentially means that my contract is still going on, right? Bank essentially has still a contract which is going to happen 1 month later. So if I have to essentially close this contract earlier, what will I need to do? What will I need to do? Yes, I will have to essentially either take this currency as per spot, but I am giving you benefit of the forward rate. So what do I do with this currency? Right? What do I do with this currency? So I have the currency available. So I am going to convert it at a certain rate. And if that rate is lesser than what I am already paying you, I need to recover that loss from you. Right? That forex loss I will recover from you. Plus, what is the other element which could be there? This loss is always, rather it is known as swap difference, right? Which you will find in the modules, it is generally referred to as swap loss, etc. What you mentioned as swap difference. So you will recover fixed charge, you will recover swap difference, and then, of course, since I am paying you in advance, I am paying you 1 month upfront, right? So whatever is the interest rate on these 100,000, 100K into the prevailing rate into the percentage interest rate. So I'm going to charge you this interest for early payment, right? That is going to be my charge for this entire example. Okay. Now, I'll take the first option which is there. Delivery. I have 3 options. Early delivery, on maturity, and late delivery. And late delivery. Right? If it is on maturity, then you will essentially convert 100K at forward rate. Agreed? Right? No problems whatsoever. No other charges payable. What happens when there is early delivery? So when you have 100K, then in that case, your charges you will pay for early payment, right? Or early delivery or early payment. So you will have bank charges, then you will have interest on early payment, and you'll also have to pay for swap difference. Are you with me? Now, these bank charges may include both fixed charges also if there is any, right? All right. Now, on late delivery, what happens? What is late delivery? So, late delivery, it means first of all, there is a automatic cancellation. Am I right?
Yes, sir.
Cancellation. And then when you deliver, subsequently, so when you deliver $100K later, it will be given to you at spot rate. Are you with me? So charges will be applicable over here in cancellation. You will not get the benefit in that case, right? Guys, are you with me?
Yes, sir.
Okay, because your forward contract has already got for automatic cancellation. So when you deliver late, you will not get the benefit of the forward rate. So if I want to maintain the benefit of the forward rate, whatever I do, meaning I want to say, for example, cancel the contract, or I want to essentially extend the contract, I need to reach out before maturity, on or before maturity, so that I have the option of extending the contract, etc. Bank is always going to be happy to do either of the things. Why? Because for every transaction, bank will earn its margin. It's going to be a cost for the customer. So you have to be very, very specific as to what you intend to do. Right? Now, I have to take some practical questions on this, and we have 10 minutes remaining today. So, I will rather explain one another small concept to you, right? So that we are optimally able to utilize our time today and in the next session, right? The next session, we'll be solving questions on the delivery and extension and cancellation part. So before I go into those, because those practical questions will take slightly longer time, so I'll just briefly introduce a very small concept which is there, which is nostro, vostro, and loro. I think we had discussed this in brief earlier, but now we need to understand the impact of this three, right? So, say for example, there is I am the customer over here, let's say AB Limited, India is a customer, right? I have a bank account with Punjab National Bank. Okay, now we both are in India. If I want to do some transaction in USD, so I am saying I want to remit because I am an exporter or importer, as the case may be, I want to do some dollar transaction. So I am going to give instructions to Punjab National Bank. Now, Punjab National Bank, how is that going to do the account? So what Punjab National Bank has done in the process is, Punjab National has opened its own account, right? Punjab National Bank has opened its own account, which say, for example, Citibank, New York. Okay, in the Citibank, New York, it has opened its own account called Punjab National Bank, India bank account, right? So just like your customer has opened an account with Punjab National Bank, Punjab National has opened its account in Citibank, New York, in USD. Currency is USD. Remember, my account over here is in INR. Okay. Punjab National Bank has opened an account with Citibank, New York, in USD. Now, say for example, there is a client over here right? Let's say I have EM Limited, which is a US company, right? EM Limited, which is a US company, okay? And AB Limited has an obligation to pay some dollars to EM Limited. Now, EM Limited has an account with, say, for example, Bank of America, of course, in USD, okay? So when AB Limited wants to pay to Bank of America over here to EM Limited, it is going to issue instructions to its Punjab National Bank that at the prevailing rate, please transfer, say for example, $50,000 to EM Limited. Now, Punjab National Bank in India does not have a USD account. So what it does is, Punjab National Bank India has a USD account in Citibank, right? So it is going to ask Citibank New York that you debit my account, right? You debit my account by 50K and transfer this 50K to EM Limited in Bank of America, USD account, right? Now, this 50K, which is in dollars, is debited from Punjab National Bank India account. Are you all able to understand? I repeat once again, AB Limited is a customer in India, has opened a bank account with PNB, Punjab National Bank India. Punjab National India Bank has opened its own account, right, in dollar currency with Citibank of New York, right? Now, AB Limited has to pay $50,000 to EM Limited. So it is instructing PNB Limited, you pay $50,000 on my behalf to Bank of America, EM Limited. So how will this transaction happen? Say, for example, the rate of exchange is $1 is equal to rupees 50, hypothetically. Okay. So what PNB will do is, PNB is going to debit AB Limited account in its bank, right? It will debit AB Limited 50,000 into 50. So that is going to become how much? 25 lakhs. Am I right? 25 lakhs rupees will be debited into AB Limited. Now, Punjab National Bank is going to instruct Citibank in New York that you pay EM Limited, US company, how much? $50K on my behalf by debiting into my account, right? So, in other words, what is PNB passing the entry? It is passing the entry. It is essentially saying customer's account debit. So, AB Limited debit to PNB dollar account credit. Are you with me? PNB dollar account credit. How much? 25 lakhs INR. Right? And that 25 lakhs is converted over here, right? And it passes on that particular Punjab National Bank over here. That account will be debited by Citibank by $50,000 and it will pay to the Bank of America. So here, Punjab National Bank, which has opened its account with Citibank, with a foreign bank in the foreign country, right, in foreign currency. I repeat, in a foreign country, in a foreign bank, in foreign currency. This account is known as Nostro account, right? This is called Nostro account for Punjab National India. This account is called Nostro account for Punjab National India, right? The same account will be referred to by the Citibank, and Citibank will say this is Vostro account. It will say it is Vostro account. It is your account in my bank, in my currency, right? So Punjab National Bank, India Bank account over here with Citibank New York, which is in USD. This is called as Vostro account for Citibank. It will be called as Nostro account by PNB. Now, say there is another HDFC Bank over here, right? HDFC Bank, and HDFC Bank wants to essentially remit, say for example, $50,000, but it does not have its own nostro account or any such arrangements with any foreign bank. Then what HDFC Bank does is, HDFC Bank knows that Punjab National Bank has its nostro bank account with Citi. So HDFC reaches out to Punjab National and says, sir, we want to make payment of $50,000 to a party in US in USD. So can you please do that on our behalf? So for HDFC, this account of Punjab National Bank, from which the payment will be made eventually, is called Loro account. Right? So nostro, mine, vostro, yours, Loro, theirs. Right? So HDFC does not have their own account. It is the third party account altogether. Right? Now in vostro, nostro and Loro, we need to do one calculation part, and that is, when you are talking about your nostro account, just like our bank account, right? You maintain your bank account on cash book basis, right? This is cash book basis, and then you have passbook basis, right? This is bank reconciliation, which we have done earlier also. What is the difference between these two? Cash book basis and bank book basis or passbook basis. In cash book, I would have the actual cash, say for example, whatever rupees is there, 50, etc., plus or minus whatever checks I have issued, right? Whatever checks I have issued, but not yet being presented into the bank, would be debited over here, right? Which generally comes in by bank reconciliation. Similarly, in the passbook, you would have certain entries which are there only on the passbook, which are generally your charges, etc. Right? So here we have to essentially prepare nostro account on the basis of cash basis, right? And your notional basis, which is your total value, including cash available and whatever transactions have already been done on your behalf, which is nothing but the cash basis, right? So that is the preparation of nostro account. We will do one sum in the next lecture on this as well, right? This is a very, very simple topic as such, so will not be a challenge for us, but nonetheless, we need to understand this concept, because whenever we talk about international trade, payments will essentially be routed through nostro and vostro, like it is happening in case of India-Russia trade as well, right? So it's 10 o'clock today. Before we conclude for the day, let us revise again what did we do today. In the previous lecture, we had done sums on forward, money market hedge and options separately. Today, we did a sum on which we were doing all the four options, that is forwards, money market hedge, options, and including if there is no hedging, right? So we covered that. Thereafter, we identified what is the meaning of swap and how the swap works, and what is the savings which is being made on account of swap by both the respective parties. It may not be same amount, right? However, it will be beneficial to both of them. And then we also introduced the concept of forward contracts termination. How does it get concluded? So it is by delivery, by cancellation, by extension, right? And the three options in that. We have essentially dealt with the concept per se today. Practical questions will be done in the next lecture. And then we also covered today the concept of vostro, nostro, and Loro account. Here also there will be one practical question which we'll be solving in the next session. So in the next session, predominantly, we are going to solve all practical questions on early delivery, cancellation, on extension, and then one question on nostro, vostro, and Loro. Okay. I hope this was all clear to everyone.
Yes, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Yes, sir. Thank you, sir. Wish you the same.